Hello students, I hope everyone is doing well. Let's start our today's practice session. In today's practice session, we are going to practice the section A of your pre-mock September 2026 exam, which is recently launched by ACCA, right? The approach will be same just like our previous practice sessions. First, we have to read the requirement, and according to requirement, we have to put our answer, right? Now, let's start from the first question. But before we start our practice session, let me tell you one thing. If you have any question, you can ask in the chat box and take your calculator, double check my calculation. And if you have any question, you can also ask that in the chat box as well, right? So let's start our practice session. The first question, what is the carrying amount of the closing inventory in Harlow Company Statement of Financial Position at 31st December 20x5? And we have to answer to the nearest $1,000, right? Let me repeat the requirement of the first question once again. Examiner asking that what is the carrying amount of the closing inventory in Harlow Company Statement of Financial Position. The year end is 31st December 20x5, and we have to answer to the nearest $1,000. Now, from your past study, you already remember that inventory is always reported at lower of cost or NRV. Let me write. We have to show closing inventory in the statement of financial position as a lower of cost and NRV. And how you will calculate the NRV? So a formula selling price minus cost of completion and minus selling cost, you will get NRV, right? What is the formula for calculation of NRV? It is the selling price minus cost of completion, COC mean cost of completion, right? And minus selling cost, right? And you will get your NRV. Then we have to compare the NRV with a cost, and we will take lower of, and that value will be reported in the statement of financial position at the year end. Okay. At 31st December 20x5, Harlow Company has 2,000 units of partially completed inventory in its warehouse, which cost $180,000 to bring to their current location and condition. Look, Harlow Company has 200 units of partially completed inventory, which has a cost of $180,000 to bring to their current condition and location. So the cost of inventory already given by your examiner is $180,000, right? It is $180,000. Now, until November 20x5, Harlow Company sold completed units at $130 per unit. What is the selling price of a completed unit? It is $130 per unit. $130 per unit. In November 20x5, a new competitor, look, a new competitor entered the market, and as a result, Harlow Company revised the selling price per unit to $95 per unit. Look, the selling price of one completed unit for Harlow Company is $130 per unit. What is the selling price? It is $130 per unit. But a new competitor entered into the market. A new competitor entered into a market, and that is the reason that the Harlow Company revised the selling price of its unit to $95 per unit. Now the selling price of the same unit is $95. Before it was $130. Before it was $130. After a new competitor, it is $95. So the selling price is already given, which is $95. Clear? Each unit required further processing at a cost of $20 per unit. Further processing means it is a cost of completion, and it is $20. Okay. Before it can be sold, Harlow Company sale agent charge a commission of 5% of the selling price on all completed sales. So the selling cost is 5% of the selling price. The selling price is $95, and the 5% of $95 will be 4.75. Now the NRV will be 95 minus 20 minus 4.75. So the NRV is 70.25. Now what are the total number of units? The total number of units are 2,000. The total number of units are 2,000. It is an NRV for the one unit. It is an NRV for the one unit. And the total number of units already given by your examiner in the question is 2,000 units. Look, it is 2,000 units. So 70.25 multiplied by 2000. So the total NRV for the total number of units will be 140,500. It is 140,500. Now compare it with the cost, and which one is the lower one? That will be the carrying amount of your closing inventory, and the lower one is the NRV, because the NRV is 140,500 and the cost is 180,000. So the lower one is the NRV, and that will be your carrying amount of inventory, 140,500. Okay, let's move towards another question. Number 2, using the deferred income method of IAS 20, accounting for government grant and disclosure of government assistance. Okay, here is the requirement that using the deferred income method, it is a deferred income method. Treat the government grant as a deferred income method, not to deduct from the cost of a non-current asset, right? We will not deduct it from the cost of a non-current asset. We will treat the government grant as a deferred income method. Which two of the following show the value at which grant and asset will be presented in the statement of financial position for the year ended 30th June 2024? So we have to click the two options, right? And it will be for the grant and as well as for the assets as well. So under deferred income method, the asset is treated separately, the government grant is treated separately. Alpha company purchased a new machinery on 1st July 20X3. It is 1st July X3. It is 1st July X3. And what is the year end? The year end is 30th June 20X4. Examiner is talking about 1st July 20X3. Today date is 1st July 20X3. And the year end is 30th June 20X4. What is the year end? It is 30th June 20X4. So it means examiner is talking about at the start of the year, not during the year. It is the start of the year. Okay. For $10 million with a useful life of 10 years. The acquisition was partially funded by $3 million government grant received on the same date. Okay, now let's do accounting first for the assets. I would like to say an asset is a new machinery, right? As the method is deferred income method, so we will treat this asset separately and the deferred income, the government grant separately. Deferred income method, right? The government grant. Okay. The cost is $10 million. The useful life is 10 years, right? So what will be the depreciation expense for this machinery? It is very simple. Cost divided by useful life. So the depreciation will be $1 million. Now, if we want to calculate the carrying value, it's very simple. Cost minus accumulated depreciation. So the carrying amount will be $9 million for machinery. Clear? Now, what about the government grant? So as the government grant received, the double entry for this government grant will be cash debit, $3 million, and deferred income credit, $3 million. What will be the initial entry for the government grant? Cash debit, $3 million, and deferred income credit, $3 million. And we will release this deferred income over the life of an asset. Why? Because of matching principle. Why? Because of matching principle. So in the first year, and the current year is X4, June X4. So for the current year, it will be 3 million divided by 10. The useful life is 10. So 3 divided by 10. So in the current year, 0.3 million will be released as a real income, and the double entry for this will be deferred income debit, 0.3 million, and profit or loss, or you may say the income will be credited by the same amount. Any question? Any question for the machinery and up to this entry for the deferred income? Okay. Now, what will be the carrying value for this government grant? So the total is 3 million, right? The total is 3 million, from which 0.3 million is released. So the remaining amount is $2.7 million. The remaining is $2.7 million. And as I already teach you that the deferred income will be treated as a liability in your statement of financial position. This deferred income will be treated as a liability in your statement of financial position. So this deferred income is reduced by 0.3 million, right? This liability is reduced by 0.3 million. So now the carrying amount of your remaining liability is 2.7 million. And this liability will now be split between the current liability and the non-current liability. It will be split between the current liability and the non-current liability as well, right? Let me repeat this once again. As the government grant received by the company will be treated under the deferred income method, so the initial entry will be cash debit and deferred income credit. Then it will be released over the life of an asset, and the life of the asset is 10 years. So 3 million divided by 10 is equal to 0.3 million. This 0.3 million will be released, and the double entry for this will be deferred income debit, and profit or loss will be credited by 0.3 million, right? So now the remaining amount of the deferred income means for your liability is 2.7 million, because the total amount of the deferred income is 3 million, from which 0.3 million is released. So the remaining amount is 2.7 million. Now we have to report this as a liability in the statement of financial position. So for the statement of financial position presentation, we will split this 2.7 million into current liability and as well as into non-current liability as well. So what will be the current liability? Any deferred income which will be released in next year means in June X5, that will be current liability, and any balancing figure will be your non-current liability. So the same amount will be released every year because the depreciation is charged on a straight line method. So 0.3 million will become your current liability, and 2.7 minus 0.3, the remaining amount, the balancing figure will be your non-current liability, right? Any question in this accounting treatment? If you have any question, you can ask. No question? Okay. Now let's move toward the option. So the first option is a non-current liability of 2.6 million. What is a non-current liability? It is 2.4 million. So the first one is wrong. Then a non-current liability of 2.4 million. Yes, a non-current liability of 2.4 million and a current liability of 0.3 million. Yes. So option B is the correct option. Now non-current asset of 9 million. So non-current asset will be presented at 9 million. So this one is also correct. So B and C option is the correct option. Okay. Now, if you focus on the requirement, the examiner asked about the grant and the asset which be presented in the statement of financial position, right? So in the exam, you have to save the time for yourself. So you have to do just the working for the statement of financial position. I'm doing this double entry, this presentation, this double entry just for your understanding, because it is a practice session, right? It is a practice session, and I'm doing extra working just for your understanding. In the examiner, if the examiner asks about the profit or loss presentation or statement of financial position, you have to do the directly, because in the exam you have to save the time, because you have a limited time frame in your exam, 3 hours, and in 3 hours you have to give 40 minutes just to section A, right? Because I always tell my students that 40 minutes for section A, 40 minutes for section B, so it's equal to 80 minutes. Now you are left with 100 minutes, so 50 minutes for one long question and 50 minutes for another long question, right? You have a very limited time in your exam for your paper, so you will avoid extra working, right? I'm doing it just for your understanding, because it is a practice session and I have more time, right? But in exam you will have a very little time, a limited time, so you have to do just the working for your on the basis of your requirement, no extra working. Clear? Okay. Let's move towards another question, and you guys will answer me for this requirement, right? Let me read the requirement first. Which two of the following are required by IAS 16? IAS 16 property plan and equipment, a very basic accounting standard. You have to answer me for this requirement. The finance director of Barrow Company, which uses the revaluation model for its property, plant, and equipment, is reviewing a checklist of requirement of IAS 16 property, plant, and equipment. They are reviewing a checklist. So which two of the following are required by IAS 16? The first one, revalue all asset under the revaluation model annually. Is this option is the correct one? We have to revalue our non-current asset, means our all asset, not a non-current assets, under the revaluation model annually. Is it correct? Answer me quickly, hurry up. Is this statement is correct? No. Very good, because we have to revalue all of our assets with sufficient regularity. There is no limited time frame for this that you have to do after 6 months, 8 months, or after 1 year, or after 2 years. You have to revalue all of the assets with sufficient regularity. So it is wrong. Second one, test all property, plant, and equipment for impairment at least annually. What about this? We have to do impairment testing annually for our property, plant, and equipment. Impairment testing annually. What about this? No. Impairment, you have to do the impairment testing for property, plant, and equipment when you get a hint, when you get an indication of impairment, then you will perform impairment testing. Annual impairment testing is only for two assets. One is the intangible asset with indefinite useful life. You have to do the impairment testing just for the two assets. One is the intangible asset, which has an indefinite useful life, and the other one is purchased goodwill. Just for these two assets, you have to do the impairment testing annually. For the rest of the assets, whenever you are getting hint, you are getting an indication of impairment, then you will perform an impairment testing, and then you will get the result whether an asset is impaired or not. Right? It's a very basic statement. And I already told you this in IAS 36 impairment of asset as well, that you have to do the impairment testing just for the two assets and on annual basis. One is intangible asset with indefinite useful life, and the other one is purchased goodwill. For the rest of the asset, whenever you get an impairment hint, then you will perform impairment testing, and the last step you will get the result whether the asset is impaired or not. Clear? So it is also wrong. Next one. Review the useful life and residual value of each asset at least annually. We have to review the useful life and residual value of each asset annually. Yes, because it is an accounting estimate and you have to review it at least annually, right? Okay, the next one. Transfer the excess depreciation from the revaluation surplus to retained earnings annually. You have the choice. It's not compulsory. You have the choice whether you want to transfer it or not. So it is also not a correct option. The last one, review the depreciation method applied to each asset at least annually. Yes, it is also an accounting estimate. So option E and C are the correct option. Clear to everyone? Okay, that's good. Let's move forward to another one. Which of the following statement is correct when determining the transaction price under IFRS 15? Which of the following statement is correct when we have to determine the transaction price under IFRS 15, revenue from contract with customer? Okay, the first option, when a contract has a variable consideration. When a contract has a variable consideration with multiple possible outcomes, an entity must always estimate the transaction price using the most likely amount method. Is it a correct option or not? And give me the reason as well, because it's a straightforward statement. What about this? When a contract has a variable consideration, what is the rules for the variable consideration? You can only include the variable consideration when the reversal is impossible. I didn't teach you that they have the multiple outcome, so you have to include the transaction price using the most likely method. No, I teach you that whenever a transaction price has a variable consideration, so you have to check for the return in for the possibility whether the reversal is possible or impossible. So if it is impossible, you can include it, but if it is possible, you cannot include it in the transaction price. So option A is wrong. Second one, if a contract include a penalty for late delivery, penalty is a variable consideration or not? Penalty. Please answer me, hurry up. Is a penalty is a variable consideration or not? Hurry up, guys. Yes, that's good. Penalty is a variable consideration. The penalty should be deducted in arriving at the transaction price only if it is highly probable that the penalty will be paid. So it's a correct option. We have to deduct the penalty from a transaction price if it is highly probable that the penalty will be paid. So it's a correct option because it's a variable consideration. For a contract will be settled in 11 months. Contract will be settled in 11 months, right? Means not more than 12 months. It is less than 12 months. The consideration must be discounted to reflect the time value of money. No. When it is more than 12 months, then you will discount it, right? Where an entity sells the good and expects some to be returned by the customer, it should recognize revenue in full. You are expecting that some goods will be returned by the customer, and then the examiner is saying that they should recognize revenue in full. No, you cannot recognize revenue in full if the reversal is possible, so you will not include it in the transaction price. And the next one is and create a refund liability for the expected return, so you cannot recognize the revenue in full. So therefore option D is also wrong. The correct option is option B. Okay. Next one. Which two of the following factor could have led to this decrease? Okay. The operating profit margin of Spring Company has dropped from 20% for the year ended 31st December 20x1 to 16% for the year ending 31st December 20x2. Look, the operating profit margin, I will say the OP margin, for 20x1 and 20x2. For 20x1, it is 20%. And in 20x2, it is 16%. So we have to tell the examiner the factor that which of the factor in result give this decrease, right? So for this type of question, first you have to write the formula. What is the formula for operating profit margin? It is very simple. I already teach you in the ratio analysis as well, that the formula is operating profit divided by revenue multiplied by 100. And the ratio will be decreased if the denominator increase, the ratio decrease if the denominator increase, and also if the numerator decrease. Right, there may be two factors. When the numerator decrease, the ratio decrease. Or when the denominator is this one. The denominator is this one. When the denominator increase, also the ratio decrease. So we have to check whether the numerator is decreased or denominator is increased. That will be the reason for the decrease in operating profit margin. The first option, Spring Company debt financing provider increased the interest rate on the company's loan. Can it be the reason? Increase in interest expense? No, because we have to do the accounting for increase in interest expense in lower order in the statement of profit or loss. First, we will get operating profit, then we add investment income, we get another subtotal, which is profit before financing and income taxes, and then we deduct the interest expense, right? So it will not operating profit margin. After conducting a review of its intangible assets, Spring Company decided to reduce the useful life of its machinery and equipment. Look, after conducting a review of its tangible assets, Spring Company decided to reduce the useful life of its machinery and equipment. They want to reduce the useful life. When the useful life reduce, it will increase the depreciation expense. When the useful life of the asset is reduced, it will increase the depreciation expense. Let me explain it with a general example. Look, let's say, for example, a company has an asset which has a carrying value of $100, and the remaining useful life is 10 years, right? Now, if I reduce the useful life to 5 years, what will be the depreciation expense? If I didn't do it, then the depreciation expense will be $10 because $100 divided by 10. If I didn't reduce this, then the depreciation expense will be 100 divided by 10. So depreciation expense will be $10. If I reduce the useful life, then what will be the depreciation expense? It will be $20, right? It will be $20. So the depreciation expense increase, it will increase the operating expense. If it increase the operating expense, it will reduce the operating profit. If the operating profit reduce, it means that the nominator reduce. If the nominator reduce, automatically the ratio will be reduced. So it is the correct one, right? And similarly, if you want to increase the useful life, it will reduce the depreciation expense. 100 divided by 15, it will give you a depreciation expense of $7. Okay, let's move to another one. Spring Company was able to negotiate better deals and obtain price deduction on raw material purchase from its suppliers. What about this? It will reduce the cost of material. So if the cost of material is reduced, cost of sale is reduced. It means it will increase the gross profit margin, and gross profit margin has a direct impact on operating profit. So it will not be a reason for the decrease in operating profit margin. The last one, Spring Company increased the wages of its managerial staff in response to a new government policies on minimum wage. Now, when increase in the wages will be recognized as an expense. Increase in wages means increase in expense. Increase in expense means decrease in operating profit. Decrease in operating profit means decrease in nominator. Decrease in nominator will reduce your operating profit margin as well. So option D is also the correct option. So B and D are the correct options. Clear to everyone? Okay. Another one. Calculate the gain on the investment to be recognized in I company's statement of profit or loss. Gain on an investment and other comprehensive income for the year ending 31st December 20x6. Remember, the year end for the company is 31st December 20x6. Okay, on 1st April 20x5, what will be the year end for this year? It will be 31st December x5. And the examiner asked the gain on the investment for x6, not for the x5. They asked the gain on investment for x6, not for the x5, right? I company made an investment in the ordinary shares of Brown Company, paying $10 million for the shares and an additional $1 million in the broker fee. So this $1 million is a transaction cost. So whether it will be expensed out or whether it should be capitalized depends on the category. If it is fair value to profit or loss, we will expense it out. If it is other comprehensive income, we will capitalize it, right? The shareholding was less than 2%. It is less than 2% of Brown Company ordinary share capital. I company made the irrevocable election. Irrevocable election. It means that The category is other comprehensive income. To classify the investment as fair value through other comprehensive income at the recognition date. So this $1 million will be capitalized, and the total cost for this investment will be 11 million. 10 million is the cost. One is the broker fee, the transaction cost, and it will be capitalized, right? On 31st December 20x5, the fair value of the investment was $12 million for the year ended 31st December 20x5. Now, we are not doing the accounting for X5. We are giving the answer for X6, right? Not for the X5. We have to give the answer for X6. Okay, and it was correctly accounted for. So if I do then an extra working just for your understanding, as the cost is 11 million for X5 and the fair value at the end is 12 million. So there is a 1 million gain, and it will be reported in other comprehensive income. And the double entry for this will be financial asset debit and other comprehensive income credit. Okay, on 30th June 20x6, now we have to give the answer after this. I company sold the entire investment for a cash consideration of $13 million. Now, what is the carrying value at the year end? It is 12 million. The carrying value is 12 million, and it was sold for 13 million. So it means there is a gain on investment of $1 million, and it will be your answer for the year ended December x6. Now, if you look, the basic data is much more than the answer, right? But the accounting treatment and you can find the answer very quickly in your paper. The data is more than 2 marks, right? So if I'm explaining in much more detail, it is just for your understanding. I'm repeating this point again and again, right? But in the paper, you have to do this question very quickly. Okay. Next one. Which two of the following statements are correct regarding the deferred tax charge for the year ended 31st December 20x6? It is all about deferred tax charge for the year ended 31st December 20x6. Okay. The following information relates to King Company for the year ended 31st December 20x6. At 31st December 20x6, the carrying amount of King Company property, plant, and equipment before any revaluation adjustment was 540,000. Before any revaluation adjustment, the carrying amount is 540,000. The tax base of the property, plant, and equipment at 31st December 20x6 was 500,000. It is the carrying amount without any revaluation adjustment, right? And the tax base is already given, which is 500,000. Now, during the year ended 31st December 2006, one item of property, plant, and equipment was revalued upward by 30,000. It is upward revaluation. The deferred tax liability at 1st January 2006 was 7,500. The income tax rate is 30%. Okay. The opening deferred tax liability is given. Now we have to calculate the closing one, and then we have to do the comparison. As I already teach you, that opening should be compared with the closing one, and you can find the deferred tax charge in profit or loss and also in other comprehensive income as well. I'm going to solve this question by 2 methods. Whichever method is feasible for you, you can follow that method in your paper and in your practice session as well. And I'm going to do it by 2 methods, right? The first method, right? Let me make a T account for the deferred tax liability, and the opening balance here is 7,500. Here is the opening balance. Here is the opening balance. I already highlighted it is 7,500. Okay. Now we have to compare the carrying value with the tax base, and then we will get a difference. Now, the carrying amount without any revaluation adjustment was 540,000. It is 540,000. When we adjust the revaluation surplus of 30,000, what will be the carrying amount? If before any adjustment, it is 540,000. And we have to adjust upward revaluation of 30,000. Then the carrying value will become 570,000. Clear to everyone? Please respond me in the chat box. 570,000. 540 is before upward revaluation, and 30,000 is upward revaluation. So due to upward revaluation, the carrying amount will be increased by 30,000. Clear to everyone? And what about you, Sidra? Okay. And the tax base is 500,000. 500,000. Now, if you look, the carrying value is more than the tax base. So we will get taxable temporary difference. And what is the taxable temporary difference? It is 70,000. What is the tax rate? It is 30%. So multiply by 30%. The deferred tax liability will be 21,000. So it is the closing value of your deferred tax liability account. It is 21,000. Here. Okay. Now should I compare opening with a closing? Now should I compare the opening with a closing? Just a small question. Should I compare with opening with a closing, and the difference will be taken to profit or loss? The difference will be taken to profit or loss? No. A very big no. Yes, not a small no. A very big no, right? Because this 21,000 deferred tax liability include the difference because of the upward revaluation as well of 30,000, and that 30,000 will be taken to other comprehensive income, not to the statement of profit or loss. So what is that amount? That is 30,000. And from my lecture, all of you will remember that the revaluation surplus is not accounted under the tax rules. So the difference is 30%. So 30,000 multiplied by 30%, it is 9,000. And the double entry for this 9,000 will be other comprehensive income debited by 9,000, and deferred tax liability will be credited by same amount. So here, the deferred tax liability will be credited by 9,000. Clear? Now you have to compare this, and the difference will be taken to statement of profit or loss, which is an increase of a balancing figure, an increase of 4,500. Yeah. So a charge of 12,000 will be recognized in profit or loss? No. A charge of 9,000 will be recognized in other comprehensive income? Yes. For other comprehensive income, it is 9,000. A charge of 4,500 will be recognized in profit or loss? Yes, this option is also correct. B and C option. Now, the second method. Now, the second method. Just look. The second method is, if examiner give you that the asset is revalued 30,000 by 30,000 and it is not included in the carrying amount. Just listen to my wording. If the scenario in the paper is that the examiner give you the revaluation surplus, right, and it is not included in the carrying value. If the examiner give you the amount for the revaluation surplus, and that revaluation surplus is not included in the carrying value, right, then it's very simple. Then compare the carrying value with the tax base, right? Let me create the T account for this as well. It is for the deferred tax liability. The opening balance is 7,500, right? And I have to calculate the closing balance as well. Look, compare the carrying value with the tax base, but this carrying value will be that carrying value that will not include this revaluation surplus amount, right? So the carrying value is 540,000, while the tax base is 500,000. Carrying value is more than the tax base, so it will give you a difference of taxable temporary difference, and that will be 40,000 multiplied by 30%. So it will give you a deferred tax liability of 12,000. Now compare the opening with the closing, and the difference will be taken into P&L. It is 4,500. Look, 4,500, 4,500. And the second method is that don't include this revaluation surplus in your carrying value and directly compare it with the tax base, right? And do the accounting for the revaluation surplus separately, as the carrying value will be increased by 30,000 and the revaluation surplus is not accounted under the tax rules, right? So carrying value is more than the tax base. So the difference is 30,000. It will give you taxable temporary difference multiply by 30%. So it is 9,000 and the double entry will be same just like this other comprehensive income debit and deferred tax liability credit. So there are these two methods. Whichever method is feasible for you, you can solve the question under that method. Okay. Now let's move forward to another one. What is the amount of cash consideration paid by the diamond company for the investment in Sapphire company? The parent company is a diamond company, the subsidiary company is the Sapphire company, and we have to calculate the cash consideration. Okay. On 1st May 20X5, Diamond Company acquired 75% of the ordinary share capital of Sapphire Company through initial cash payment and agreed to pay contingent consideration to the shareholder of Sapphire Company. The fair value of the contingent consideration was assessed to be 350,000 by the Diamond Company on this date. Okay. Now, if I tell you that the total consideration paid consists of the cash consideration as well as the contingent consideration, and by adding these two it will give you the total consideration paid, right? Now the contingent consideration value is given, which is 350,000, and we have to calculate the amount for the cash consideration, and we are also have to calculate the total consideration as well. Now from here you will calculate the total consideration paid. You can calculate it by from the working number 2, the goodwill, right? If examiner give you the goodwill at the acquisition date, the fair value of net asset at acquisition date, the fair value of NCI at acquisition date, and from there you can calculate the total consideration. Then the total consideration will be compared with contingent consideration, and any difference between these two will be your cash consideration, right? So this will be the technique for calculation of any consideration. If the examiner asks, if it is more than one, means 2 to 3 consideration, an examiner provided you the working for 2, let's say for example, if it is cash consideration, deferred consideration, contingent consideration, an examiner give you the value for the deferred and contingent, but they didn't provide you the value for cash consideration. So you have to prepare this structure, and the total consideration will be found by the from working number 2, goodwill, and then you have to compare that 2 consideration with the total, and the difference will be your cash consideration. So it can be solved by this structure easily. So now let's prepare the structure for the goodwill. So it will include consideration paid plus fair value of NCI at acquisition date, and then you have to deduct the fair value of net assets at acquisition date, and from here you will get a value of goodwill. Okay. Now, Diamond Company calculated the NCI interest using the fair value at the date of acquisition, which was estimated to be 150,000. So the fair value of NCI is 150,000. The goodwill arising on the acquisition was calculated to be 400,000. So the goodwill is also given at acquisition date, which is 400,000. Now the following figures for the diamond companies are relevant. Ordinary shares of $1 at acquisition, which will help you to calculate the fair value of net assets at acquisition date. Retained earning at 1st January 2005 at the start of the year is given, profit figure is given, and the profit of Sapphire company have accrued evenly throughout the year. If you look, the year end for the company is 31st December 20x5, and the acquisition date is 1st May 20x5. So it is a mid-year acquisition. And in a mid-year acquisition, you have to calculate the retained earning at acquisition date. And how you will calculate the retained earning at acquisition date? I told you that you have to prepare the two methods, and whichever one is feasible for you, or whichever method data is provided by the examiner, you can use that method. One is the opening and retained earning, and the other one is closing. If you look, no data for closing is given, the opening retained earning is given, right, and the profit figure is given. So we have to use the data for the opening retained earning formula. Now, for the net assets at acquisition date, the value of the ordinary share capital is 600, and it is provided you in term of $1,000. So it is 600,000, right? Now I have to calculate the retained earning at acquisition date. The opening is given. The opening retained earning, which is $350, and I will add the pre-acquisition profit. I will add the pre-acquisition profit, which is 140 multiplied by the acquisition is 1st May, and the year start is 1st January. So January, February, March, and April, the pre-acquisition profit will be for the 4 months. So 140 multiplied by 4 divided by 12 and multiplied by thousands. It is 46667. 46667. So the retained earning at acquisition date will be 39,667. 39,667. So this will be retained earning at acquisition date. And the value of the net assets will be 99,667. So it is 99,667. Now do the comparison. You can find the value of total consideration paid. So if I compare it, the minus, if I shift it to the other side of the is equal to, this minus will become plus, and this plus will become the minus, right? So by comparison, the consideration paid will be 124,667. It is 124,667. Now compare these two. The difference will be your cash consideration, which is 89,667. Option D. This is the complete working. Let's look. If you have any question, you can ask. Okay, clear to everyone? Should we proceed? Okay. The next one, what is the warranty provision that Walker Company should recognize in its statement of financial position at 30th June 2005 to the nearest dollar? So we have to find the value for the warranty provision in the statement of financial position at 30th June 2005. Okay. Walker Company reporting date is 30th June 2005. They provide a 1-year warranty with each unit sold during the year ended 30th June 2005. During the year, Walker Company sold 2,000 units. No warranty claim have been settled by 30th June 2005. Past experience indicates that no repair are required for 80% of the goods sold. No repairment is required. On average, 15% of the goods sold required minor repairs at a cost of $600 per unit, and the remaining goods require major repair at a cost of $12,000 per unit. So we will use which method for the calculation of warranty provision? Which method? Most likely outcome or expected value analysis? And Winston is going to answer me. Winston, answer me. Which method should we use for the calculation of warranty provision? Most likely outcome or the expected value analysis? Hamza, you can help him. Expected value analysis, that's very good. Okay, so now 80% chance that no repair, so it will be 0. 15% will have a repairing of cost of $600, and the total is 2,000 units, right? Or I can write it like this as well. 2,000 are the total number of units, multiply by 80%, that they will require no repairing, so it will give you 0. The second one is the total units are 2,000, of which 15% will require a minor repair of $600 per unit. So 2,000 multiplied by 15% multiplied by 600. And it give me an answer of 180,000. The second one is that the total is 2,000, of which the remaining, so 80 plus 15% is the 95%, and the remaining is 5%. It will require a major repairing of $1,200. So it is 120,000. So by adding all these three, you will get a total value of warranty provision. Clear to everyone? 300,000. Okay. Now the next. How will this change in accounting policy impact the financial statement of G company for the year ended 30th June 20X2? So there is a change in accounting policy, and we have to tell the examiner that how this accounting policy will impact the financial statement of the G company. G company applied the cost model for its investment property for many years, starting from 1st January 20X1. Company shifted to the fair value model for investment property. Since fair value are higher than the carrying amount for all the investment property, a fair value gain of 40 million was recorded in the financial statement. There is no change in the estimated useful life of the investment property. So look, the G company shift from the cost model to fair value model. They shift from the cost model to fair value model. Okay. So if they shift from the cost model to fair value model, so they will charge no depreciation. The depreciation will stop. So if the depreciation will stop, it will reduce the expense. If the expense is reduced, it will increase the operating profit. Clear to everyone? It will increase the operating profit for the G company. If they shift from the cost model to fair value model, they will stop the depreciation expense. If no depreciation expense, the expense will reduce. If the expense will reduce due to the change in accounting policy, the operating profit for the G company will increase, right? So the first option is both the operating profit margin and the gearing will increase. So we already talked about the operating profit margin, that the operating profit margin will increase because the G company will stop the depreciation expense. It will reduce the operating expense. So if operating expense is reduced, the operating profit will increase. If the operating profit increase, it will automatically increase the operating profit margin, because the formula for the operating profit margin we already discussed is operating profit divided by the sales. So operating profit increase, the denominator increase, the ratio will increase. But how it will affect the gearing of a company? You have 2 to 3 minutes. Just think and tell me that how it will affect the gearing of the company. If I talk about this, that the depreciation expense will stop, the operating profit will increase. There is a 40 million gain. It will be recognized as an investment category of the statement of profit or loss. So it will increase the profit before financing and income taxes as well, right? So how it affect the gearing of a company? How? If you look to the second option as well, look, both the profit before tax and the gearing will decrease. No, the profit before tax will increase because the operating profit will increase by this stoppage of depreciation, and due to recognition of fair value gain in the investment category, the profit before financing and income taxes will increase, and automatically by seeing these two hints, the profit before tax will increase. But examiner is always mentioning about the gearing. Look, right? So if we state that the second option is wrong because the profit before tax will increase, but why the examiner is mentioning the gearing, and again? Look to option C. Profit before tax will increase and the gearing will decrease. And the last option, profit before tax will stay the same while the gearing will go up. What is the effect on the gearing of the company? Yes, just listen to me carefully now, that how you are going to tackle this type of question when you know nothing. Now just think, what is the formula for the gearing? What is the formula for the gearing? The formula for the gearing is debt divided by equity. What is the formula for the gearing? It is debt divided by equity. And in equity, we include retained earnings. Now I think you are going to solve this question, right? Now I think you are going to solve this question, because I already give you a hint that the formula for the gearing is debt divided by equity. When you know nothing about the option, that why examiner is giving me the gearing, right? So please write the formula of that ratio as I did. Like the gearing will be calculated as debt divided by equity, and equity included the retained earnings, and retained earning can be increased by the profit. If the profit is higher, automatically the retained earning will be high. If the retained earning is higher, automatically it will increase the equity. If it increase the equity, so it means that the denominator will increase. So if the denominator increase, automatically the ratio will decrease, right? So the profit before tax will increase and the gearing will decrease. So option C is the correct option, because you have to stop the depreciation, profit will increase, you have to include a fair value gain in the investment category, right? So automatically the profit will be increased by these two. The profit will increase, but it will reduce your gearing. How? The gearing is calculated as debt by equity. Equity include retained earning. Retained earning is affected by the profit. Retained earning is affected by profit. If the profit increase, automatically retained earning will increase. If profit is reduced, retained earning will be reduced, right? Because retained earning is affected by profit figure. So if it increase the profit for the J company, so the profit increase, automatically the retained earning increase, it will increase the equity. If equity increase, so denominator increase, the denominator increase will lead to decrease of the ratio. So the profit before tax will increase and the gearing will decrease. Now it is clear? Okay. Another one. Which of the following best describe the objective of IFRS S1 general requirement for disclosure of sustainability related financial information? Did you remember the first lecture, which I already discussed about the boards, the two boards? One is the IASB, International Accounting Standard Board, who is responsible for the developing and publishing of IFRS's accounting standard. And the other board was ISSB, International Sustainability Standard Board, who is responsible for sustainability standards. And I already told you in my opening session and the first session that there are two standards which is published and by the ISSB. One is the S1, the other one is S2. Now the examiner is asking about the correct option for the S1, IFRS S1, Sustainability Standard S1. Now there are two standards which is published by the ISSB. One is the S1 and the other one is 2. No other IFRS is developed by the ISSB till this date, right? Now let me give you a quick review that what is the difference between, let's just give me a second, please. Okay. The screen is clear to you, visible to everyone? Okay. Now, there are two standards. One is the S1, the other one is S2. Now, let me give you a quick review that what is the difference between the S1 and S2. Look, the name of the S1 is the general requirements. Look, focus on the name. The name of the S1 is the general requirement for disclosure of sustainability related financial information. General requirement for disclosure of sustainability related financial information, while the name of the S2 is climate related disclosure. I already discussed that these are disclosure related standard, but it is a compulsory disclosure, right? So the name of the S1 is general requirement for disclosure of sustainability related financial information, while the S2 is climate related disclosure. So if I make it simple, so if whenever we talk about the sustainability in a general, whenever we talk about the sustainability in a general, right? In a general, when we consider the complete sustainability issues and the opportunities. So S1 is going to cover this. But whenever we talk about the specific things, and that thing is a climate related issue, so S2 is going to cover that issues and that opportunities, right? Whenever we talk about the sustainability in a general, so S1 is going to cover that issues and opportunities, right? But whenever we talk about the specific climatic related issues, specific that relates to just the climatic related issues, so S2 is going to cover that, right? So I already write here that is sustainability in general, and it is climatic specifically. So if we talk about general, so a water issue, employee issue, biodiversity, climate change, and supply chain, etc., right? So it is a general sustainability issue. So S1 is going to cover this. But whenever we talk about the climatic change specifically, So S2 is going to cover this, like flood issue, right? Whenever there is a storm or extreme weather, greenhouse gas emission, climate regulation. So S2 is going to cover that, right? So in simple, if I make it simple, whenever we talk about the sustainability generally, so S1 will cover that. But whenever we talk about the climatic related issues, specifically, exclusively related to the climatic change, so S2 is going to cover that, right? If we talk about the climatic change, S2 is going to cover that. But whenever we talk about the sustainability in a general, S1 is going to cover that. And who are the users? The users are mainly the primary user, which include the investor and other providers of the capital, right? So in simple, I write that whenever we talk about the general or overall standard, so it is S1. So whenever we talk about the climatic specific standards, so S2 is going to cover that. Clear to everyone about S1 and S2? Sustainability standard 1 and S2. Clear to everyone? Any question? Okay, that's good. So now let's move towards the section A and section B. Okay. So the first option, to establish disclosure requirement exclusively for climate-related risk and opportunities to enable investor to assess the impact on the entity future cash flow. Is it a correct statement or wrong? Exclusively for climate-related risk, S2 is going to cover this. To provide a framework that guides companies on how to develop and communicate their sustainability strategy, no. To all stakeholders, including employee, government, and communities, no. It is mainly concerned with the primary users, which include the investor and the providers of the capital. So it is also wrong. To require companies to disclose information about sustainability related risk, now they are talking about general sustainability related risk and opportunity that is useful to investor in making resource allocation decision. Option C is the correct one. To set out the environmental reporting requirements, specifically environmental reporting requirements that inform companies on how to report on their use of natural resources and their impact on the environment, no. It covers all sustainability related issues and opportunities. So option C is the correct option. Okay. Now, next, calculate the cash generated from operation for the year ended 31st December 20x5, a question from the cash flow. The following information has been extracted from the financial statement of Lewis Company for the year ended 31st December 20x5. Okay, so whenever we calculate the cash generated from operation, it always starts from the operating profit. And the operating profit is already given, which is 620,000. Profit before tax, we have to ignore this. It is just given for the confusion, right? Depreciation charge. So depreciation is a non-cash expense and it will be added back. Loss on disposal of equipment. So loss on disposal of equipment is also a non-cash expense, so it will be added back. Increase in inventory. Increase in inventory is bad for the cash flow, so it will be deducted. Decrease in receivable is good for the cash flow, so it will be added back. An increase in trade payable is also good for the cash flow, so it will also be added. Now, The answer is 725,000. A simple, straightforward. 725,000. Okay. What is the diluted earning per share of C company at 31st December 20x5? We have to calculate the diluted earning per share, not a basic earning per share. C company has an issued share capital of 5 million on 1st January 20x5. So the opening shares are given as 5 million at a par $1 per share. On 1st September X5, C company made a bonus issue of 2 new shares for every 5 shares held. So there is a bonus issue, and bonus issue is always assumed that they are issued at the start of the year. So it is 2 million, and the total number of shares are 7 million, right? We don't have to multiply the fraction for the year because the bonus issue is always assumed that they are issued at the start of the year until if there is another issue after the bonus issue, right? So then we have to multiply the bonus fraction and the fraction for the year as well. If there is no share issue after the bonus issue, then no need to multiply the fraction for the year and also bonus fraction. Profit after tax is 756,000. So the earnings are 756,000. C company has convertible loan notes of 300,000 issued at a 5% interest rate. The loan can be converted into 60 shares for $100 after 5 years. The tax rate is 30%. So let's calculate first the shares that we will always assume that the shareholder are going to convert it. If you remember IAS 33. So it is 300,000 and each $100 share will be converted into 60 shares. So 300 divided by 100 loan notes multiplied by 60. So it will give you total number of 180,000 plus 7 million. So the number of shares are 718, 2, 3, 4. Now the interest rate will increase your earning. Interest saved. So it is 300,000 multiplied by 5%. So it is 15,000. And you have to calculate the extra tax on the earnings saved, which is 30%. It is 4,500. So give me a second, please. It's Azan here. So give me a second, please. Okay. So now the earnings will be 756,000 plus 15,000 minus 4,500. So the total earnings are 766,500. Now the formula for the earning per share is the earnings divided by the number of shares so the earning per share is 0.106. So if I round it, it is 0.11. Option A. Next one. Which of the following is correct regarding Leslie factoring of trade receivable for the year ended 30th December 20x3? Okay. On 1st December x3, Leslie company sold 2 million of trade receivable to Rayleigh company. Leslie company received an immediate payment of 1.8 million under the factoring agreement. Any receivable not collected after 6 months will be sold back to Leslie company. So it means that the control has not been transferred, right? Because the control is retained by the Leslie company, because after 6 months, if it is not recovered, it will be sold back to Leslie company. So if no control is transferred, you cannot de-recognize the financial asset, which is a receivable. You will not de-recognize it. Any amount received will be treated as a loan, right? So the first option is 200,000 should be recorded as an administrative expense for the disposal of the receivable. No, you will not de-recognize the financial asset because the control is not transferred. The receivable should be removed from the statement of financial position. No, because the control is not transferred, so you will not de-recognize the financial asset. Revenue of 1.8 million should be recognized for the year. Same scenario. Wrong. The receipt of 1.8 million should be treated as a loan. So this one is the correct option. It will be treated as a loan. Okay. Last question of the section A. What impairment reversal should be recognized in Rio Company statement of profit or loss for the year ended 31st December 2086 to the nearest dollar? We have to calculate the reversal of the impairment that should be recognized in Rio Company statement of profit or loss. So if I remind you that the impairment can be reversed at lower of, it can be reversed at a lower of carrying value if no impairment has been performed and the recoverable amount, right? So now let's solve it. On 1st January X1, the current year end is X6. Now examiner is talking about X1 and also at the start of the year. Rio Company purchased plant for 6 million and began to depreciate it on the straight line basis over a useful life of 10 years. Okay. At 31st December 20X5 means after 5 years, X1, X2, X3, X4, and X5 after 5 years, the plant was damaged by an electrical fault and was tested for impairment. The recoverable amount of the plant was 2.5 million. Now, if I compare the carrying amount with a recoverable amount, so the carrying amount can be calculated as the cost, which is 6 million, divided by the useful life is 10 years, and after 5 years, with multiply it directly with the remaining useful life, you will get the carrying value, which is 3 million. While the recoverable amount is 2.5 million. So the carrying value is more than the recoverable amount. So it means that the asset is impaired by 500,000. And the double entry for this will be profit or loss debit by 500,000. And that asset, that plant will be credited by the same amount, 500,000. Well, for everyone. Now, by 1st December 2086, after 1 year, after the impairment, right? After 1 year, after the impairment. So if I want to calculate the carrying value after the impairment expense and the depreciation expense, so the formula for that is the recoverable amount divided by remaining useful life. So the recoverable amount is 2.5 million. The remaining useful life is 5. And after 1 year, the remaining useful life will be 4. So directly multiply it with remaining useful life. You will get the carrying value directly. So divide by 5, multiply by 4. It is 200,000. And the plant was fully repaired and restored to its maximum production capacity. The recoverable amount of the plant at this date was estimated as 2.6 million. It is the recoverable amount. If no impairment is performed, what will be the carrying value? So it can be calculated simply 6 million divided by total life multiply. It is 31st December 2006, so the remaining life will be 4. It will be 2.4 million. Which one is the lower one? Carrying value if no impairment is performed. So it can be reversed up to this amount, right? Up to 2.4 million. So the difference is 400,000. And the double entry for this will be asset debit by the same amount and profit or loss will be credited by the same amount. So the reversal of impairment which should be recognized in profit or loss is 400,000. It was the last question of your section A. So if you have any question in this, you can ask.